Well, we made it. After spending the last 2 weeks discussing the sale to owner-operators and strategic buyers, we're going to wrap up the discussion today by doing a deeper dive into selling to financial buyers. This represents a group who doesn't want to actively operate the business. Instead, they want to acquire the company and have existing management stay on to handle the day-to-day operations. When we think of financial buyers, it's typically private equity groups, but family offices would fall into this category as well. Financial buyers are often looking for businesses that have at least some of these characteristics: recurring revenue, high rates of revenue growth, high gross margins, low capital expenditure, superior product or service, growth industries, disruptive product or technologies, or stable companies in industries that are geographically specific and can be rolled up. Since the businesses have to be able to stand on their own, they need to have strong infrastructure in place in the form of systems, processes, technologies that streamline the operation, and businesses that can scale. They require strong management, sales and marketing strategy, high quality of earnings, and legal compliance. You might hear that financial buyers aren't interested in buying anything under $10 million in revenue. And when you look at the infrastructure needed to be attractive, you start getting a sense why. Selling to a private equity group can be a great option for a business owner who isn't ready to retire, but wants to create some liquidity and maintain partial ownership to participate in the future upside. It also works well for companies that have endless growth opportunities, but need more resources to pursue them. Private equity may be the most flexible for creative deal structuring. Over the course of operating a business, an owner might find they've inadvertently created potential tax problems or transition issues, and these can be solved with the appropriate use of tax code, capital structure, or employment incentive agreements. As the financial buyer's primary businesses in acquiring and divesting companies, the appetite to explore scenarios that work well for all parties might be more robust than the strategic buyer who doesn't regularly assemble such deals. Since financial buyers are typically well capitalized, there might also be fewer restrictions from additional debt or equity partners. But challenges can also arise in selling to a private equity buyer. Assembling the infrastructure necessary for the business to scale and be attractive to private equity, it's expensive. Owners might find that they can make the same income at lower levels of sales and without the incremental risk of the investment. In industries where strategic buyers may not need the seller's infrastructure because they already have the existing software platforms, equipment, and systems, a seller might find a path to attractive deals without taking on the additional fixed cost and operational risk. Many business owners have probably heard horror stories about others being tied up in a deal for months, only to have the price cut and the deal dramatically change immediately prior to closing when dealing with private equity buyers. While we don't believe financial buyers typically have ill intentions going into the deal, the nature of this type of buyer is to maximize the return on investment while balancing risk. So, should their due diligence show more risk than was initially believed, this cohort might be more likely to rebalance the risk reward more aggressively than others. That wraps our discussion on the types of buyers. We're going to come back next time, start talking about the due diligence process. Stay tuned.